Everyone's talking about recessions, the sky is falling, and it's all doom and gloom, right? Wrong. A recession could actually be one of the biggest opportunities for you to build serious wealth. It sounds crazy, I know, but hear me out. Most people panic, they sell, they hide their money under the mattress, metaphorically speaking, of course. But for those of us who understand how things really work, a downturn is like a Black Friday sale for assets. It's when fortunes can be made if you know what you're doing. In today's video, I'm going to lay out 3 simple, actionable steps that you can take to not just survive a recession, but to actually profit from it. We're not talking about complicated financial jargon or strategies that only Wall Street pros can use. These are straightforward principles that anyone can understand and apply. Let's kick things off with step 1, understanding market cycles. The economy moves in waves. It goes up, it comes down, and then it goes back up again. Think of it like the seasons: spring, growth; summer, peak; autumn, contraction; and winter, recession. Recessions are a natural, normal, and even healthy part of this cycle. They clear out the excesses, force businesses to become more efficient, and shake out the weak players. The first mindset shift is to stop fearing recessions and start seeing them as an inevitable part of the process. If you understand that downturns are temporary and that recovery always follows, you won't make emotional decisions. Recognizing these cycles helps you make informed investment decisions. For example, if you see signs that the economy is overheating, you might decide to be a bit more cautious. Conversely, when a recession hits and asset prices are falling, that's when your understanding of market cycles really pays off. You'll know that this is often when the best buying opportunities appear. Think about the major recessions we've seen in the past: the dot-com bust in the early 2000s, the financial crisis in 2008. Both were scary times, but the market recovered and reached new all-time highs. Those who understood the cycle and invested during the downturn made an absolute killing. It's about having that long-term perspective. If you're investing for the next 10, 20, or 30 years, a recession that lasts a year or two is just a blip on the radar. It's a temporary sale. Imagine your favorite store having a 50% off sale. You wouldn't run away scared, would you? You'd probably rush in to grab some bargains. It's the same concept with investing during a recession. This understanding prevents you from making the classic mistake of buying high and selling low. Instead, you learn to do the opposite, or at least to hold steady and ride out the storm. Take some time to look at historical market charts. You'll see these cycles playing out again and again. This visual evidence can be really powerful in reinforcing the idea that downturns are not permanent. They are temporary phases in a much larger, upward trending picture. This knowledge also helps you filter out the noise. During a recession, the media loves to sensationalize things. If you don't understand the underlying mechanics of market cycles, it's very easy to get caught up in that fear and make bad decisions. But if you're grounded in this understanding, you can see past the headlines. You start to see recessions not as a threat, but as a period of reevaluation and repositioning. Strong companies often emerge even stronger from recessions. So, to recap this first crucial step, embrace the cycle. Understand that recessions are normal and temporary. You understand that recessions are just part of the economic weather forecast. Great. But just like you wouldn't go out in a blizzard without a good coat, you shouldn't face a recession without some financial protection. That brings us to step number 2. Diversify your investments. Diversification is simply the practice of spreading your investments across various asset classes to reduce your overall risk. The idea is that if one part of your portfolio takes a hit, other parts might hold steady or even go up, cushioning the blow. During a recession, this becomes absolutely critical. Think about it. If all your money is tied up in one specific tech stock, and then a recession hits and that particular sector gets hammered, you could lose a massive chunk of your wealth very quickly. But if your money is spread out across different types of investments, some stocks, some bonds, maybe some real estate, a bit of cash, the impact of a downturn in one area is much less severe. So, what kind of asset classes are we talking about here? Let's break down a few that tend to behave differently, and some that can be particularly useful during a recession. First up, you have your defensive stocks. These are companies that sell essential goods and services that people need regardless of how the economy is doing. Think about consumer staples, food, drinks, household products. People still need to eat and brush their teeth, even in a recession. Utilities are another classic example of defensive stocks. People still need electricity, water, and gas. Healthcare companies also tend to be more resilient because, unfortunately, people get sick whether the economy is booming or busting. These types of stocks might not give you explosive growth during good times, but they often hold their value much better during downturns. Then, you have bonds. Bonds are essentially loans you make to a government or a corporation, and they pay you interest. High-quality government bonds in particular are often seen as a safe haven asset. When stocks are crashing, investors often flock to bonds, which can push their prices up. Corporate bonds can also be part of a diversified portfolio, but you'd want to focus on higher-rated investment-grade bonds during a recession. The key with bonds is that they often move inversely, or at least differently, to stocks, providing that crucial balance to your portfolio. Next up, let's talk about gold and other precious metals. When people lose faith in paper currencies or traditional financial assets during times of crisis, they often turn to gold. It's seen as a hedge against inflation and uncertainty. While gold doesn't pay dividends or interest, it can act as a good insurance policy for your portfolio during a recession. Real estate is another big one. Owning rental properties, for example, can still provide steady cash flow even in a downturn, as people will always need a place to live. If direct ownership of property isn't your thing, you can also invest in real estate investment trusts, or REITs. These are companies that own and operate income-producing real estate, and they trade on stock exchanges like regular stocks. And finally, don't underestimate the power of cash. In a severe downturn, cash is king. Having a solid cash reserve gives you incredible flexibility and peace of mind. Chapter 3: Recession Riches, Spotting and Seizing Once-in-a-Decade Deals. We've talked about understanding the game and protecting your downside. Now for the exciting part, step number 3, take advantage of opportunities. As the famous saying goes, be fearful when others are greedy, and greedy when others are fearful. During a recession, there is a lot of fear out there, which creates incredible openings for those who are prepared. One of the most obvious opportunities that arise during recessions is buying undervalued stocks. When the market panics, even shares of fantastic solid companies with great long-term prospects get beaten down. Their stock price might drop 30%, 40%, even 50% or more, not because the company is suddenly terrible, but simply because overall market sentiment is negative, and people are selling indiscriminately. This is your chance to pick up shares in high-quality businesses at a significant discount. Imagine being able to buy into some of the best companies in the world for cents on the dollar, compared to what they were trading for just a few months earlier. This is how legendary investors like Warren Buffett have made a significant portion of their fortunes, by buying when there's blood in the streets. Of course, this requires research and conviction. You can't just buy any stock that has fallen. You need to identify companies with strong fundamentals, good balance sheets, sustainable competitive advantages, competent management, and a clear path to future growth. Another major area of opportunity is real estate. Just like with stocks, property prices can take a hit during a recession. You might see an increase in foreclosures or more sellers who are highly motivated to sell quickly. This can create opportunities to buy properties at prices that were unimaginable during the boom times. Beyond stocks and real estate, recessions can also be a surprisingly good time to start a business. Competition might be lower as other weaker businesses struggle or close down. Office space and other resources might be cheaper. Talented employees might be easier to find if there have been layoffs in other sectors. If you have a solid business idea that solves a real problem, and you can operate leanly and efficiently, a recession can actually provide a less crowded field to get started. Many successful companies we know today were actually founded during recessions. It takes courage and a good plan, but the potential rewards can be substantial if you can navigate the challenging environment. Investing in yourself is another opportunity that often gets overlooked. When the job market is uncertain, or if you find yourself with more free time, a recession can be the perfect opportunity to upgrade your skills, get a new certification, or even go back to school. Enhancing your human capital makes you more valuable in the job market. This could mean learning a new software, mastering a trade, improving your public speaking skills, or getting an advanced degree. These investments in yourself pay dividends for the rest of your career. To take advantage of any of these opportunities, you need two crucial things. You need to have cash available, and you need to stay informed and be ready to act. Opportunities during a recession can be fleeting. If you're not prepared, they can pass you by. This means keeping a close eye on the markets, on specific companies or properties you're interested in, and on broader economic trends. So there you have it. 3 simple yet incredibly powerful steps to help you not just navigate, but actually profit from a recession. First, understand that market cycles and recessions are normal, inevitable parts of the economic landscape. Don't fear them, understand them. Second, build your financial armor through smart diversification across different asset classes to protect what you have. And third, be prepared to actively take advantage of the incredible buying opportunities that fear and panic create in the market. Recessions can be scary if you're unprepared, but if you follow these principles, they can genuinely be a period where you lay the foundation for significant future wealth. Instead of seeing a downturn as a crisis, start seeing it as a period of immense opportunity. The strategies we talked about today aren't get-rich-quick schemes. They're about playing the long game and making smart, informed decisions.